In this next video, let's take a look at preparing a segmented income statement. Let's assume that ABC Company sells two products, WeBan and GreenGrow. You're given the unit selling price for each, the variable cost per unit for each, and traceable fixed costs for each. So what that means is this $133,000 is direct fixed cost for WeBan only, and $40,000 is direct fixed cost for making GreenGrow. Last year, the company produced 40,500 units of WeBan, so I went ahead and put that on top of WeBan to help us with our calculations, and 17,000 units of GreenGrow. So I went ahead and put that above GreenGrow to help us with our calculation. Also, there was an additional yearly fixed expenses that are common, we'll talk about that more in a minute, of $102,000. Okay, so let's go ahead and prepare. And let's start with WeBan. So sales would be 40,500 units, and WeBan sells at $11 per unit. So therefore, sales for WeBan, 445,500. Variable cost are 40,500 units. Variable cost is $2.60 a unit for 105,300. I will subtract to get a contribution margin of 340,200. Okay, next I will bring down the traceable fixed cost for WeBan of 133, and then I will subtract that from the contribution margin. And our product segment margin is 207,200. We stop there because we don't take common cost out of the individual products. Okay, let's go ahead and do GreenGrow. Same situation. 17,000 units sold times $39 a unit gives us 663,000. 17,000 units sold times $11 a unit gives us 187,000. Subtract to get the contribution margin of 476. The traceable fixed costs for GreenGrow are given at 40,000. I will subtract that from the contribution margin for a product line segment margin of 436. And again, I will stop there. Okay, now what I will do is add all the numbers for WeBan plus all the numbers for GreenGrow in order to get the total for the company. So for sales, I'll add 445,500 and 663 for a company total of 108,500. And then because I had it set up for it, it automatically did it for the rest. So for example, variable cost 105,300 plus 187 gives me 292,300. Now remember here, there's additional common fixed expenses of 102,000. So in the total column only, I do need to put that common fixed cost of 102. A common fixed cost means you can't eliminate it by eliminating WeBan or GreenGrow. It's kind of like the rent. If you stop making one product, your rent probably isn't going to change. So that's a common fixed cost. Okay, I will take the 643,200 minus the common fixed cost of 102, and you will get net operating income for the company of 541,200. We are now complete with the segmented income statement. Now, in exercise 6.5, we're going to continue on, and I've already helped you out by putting some of the numbers here to get us a head start, by calculating some of the break-evens. First of all, we want to calculate the break-even for the company as a total. So we will use this one here, and it wants break-even in sales. Break-even in sales is fixed cost divided by the contribution margin ratio. Now, when we're talking about the company overall, we want to include the traceable fixed cost of 173 and the common fixed cost of 102. So for my top number, it will be my fixed cost of traceable of 173 plus comment of 102. That will give me total fixed cost of $275,000. Okay. And divided by, we want to get the contribution margin ratio. So again, we go to the total company column. To get as a ratio, we take the contribution margin of $816,200 divided by total sales of $1,108,500. And I wrote it out there. So when you divide that out, you get 0.74 for your contribution margin ratio. Now divide 275,000 by 0.74, and the overall company break-even in sales is $371,621. I rounded it up to the nearest dollar. Now it wants us to get break-even for WeedBAM and GreenGrow individually. Okay, so let's look at just the WeedBAM column. Again, it's going to be the fixed cost, but since we're just dealing with WeedBAM, it will be its traceable fixed cost divided by the contribution margin ratio, again, just for WeedBAM. Okay, fixed costs for WeedBAM are 133. So notice I started with traceable fixed cost of 133. To get the contribution margin ratio for WeedBAM, again, look at the WeedBAM column. I take the contribution margin of $340,200 and divide it by sales of $445,500. Okay, I did go ahead and write it out here. So therefore, it would be the fixed cost of $133,000. To get the contribution margin ratio, when I divide that out, I get 0.76, 76%, but use 0.76 to divide. And that gives me break even for WeedBAM of $175,000. Okay, let's do break even for GreenGrow, and I'll fix the spelling there. So we'll go to the GreenGrow column. So here's the GreenGrow column. GreenGrow's traceable fixed cost of $40,000. So notice I started out with $40,000. To get the contribution margin ratio for GreenGrow, I would take the contribution margin of $187,000. Oh, I'll take that back. Sorry, the contribution margin is $476,000 and divide it by sales of $663,000. And that's what I wrote out here. So 40,000 divided by, and when you divide those numbers, you get 0.72 as your contribution margin ratio. So the break even on just the GreenGrow in sales dollars is $55,556. Thank you very much.